Hi, I'm Jeff Bermet. Along with Nick Davis, we're the managers of the Libero Cautious, Dynamic, and Solutions portfolios. September was another very good month for all three funds, and it's proving to be a very strong year for all of the funds as well. And I think it's worth sort of stepping back and looking from high altitude. What's the environment that is helping to drive strong equity market returns this year and to keep bond markets relatively subdued? First, the Fed cut rates in September. They've clearly changed their bias to thinking they're going to cut rates further because of downside risks to the labor market in the US. Also, we have the Bank of England has been easing. They didn't cut in September. They may cut later this year, perhaps after the budget, but their bias is to still lower rates. The ECB has brought rates down to 2%, but they haven't ruled out further cuts were growth to stumble or inflation to fall further. So we have a backdrop where central banks are still the market's friend. Secondly, governments are not attempting to rein in spending at all. Usually you should only run large deficits when you're in a recession or a slowdown. So that's a little bit troubling in the long run, but near term, government spending a lot of money is again good for markets. And in particular in Europe, we have the feature of governments spending a lot of money on defense or promising to spend a lot of money on defense. And then we still have the phenomenon of the artificial intelligence CapEx spending by the big mega cap tech firms. 40% of the growth in US gross domestic product in the first half of this year was because of artificial intelligence capital spending. So it's extraordinary how important this spend has become in driving the economy. And it may be masking underlying weakness in other areas of the economy. This is something we have to watch. Another area that's been very successful for us is what's happening in commodity prices, particularly gold and silver. They have been rapidly appreciating all year. And they may reflect a sense in financial markets that central banks are willing to tolerate or accept a little bit higher inflation than target. So market participants are saying, well, if inflation's going to run higher, I don't want fixed income. Let me buy gold. But that's maybe something to think about. If commodities are pointing to higher inflation, ultimately that could be a problem. But near term, it doesn't appear to be. And again, in the bond markets, you've seen the front ends in the US and the UK rally because of easing by those central banks, but you've seen stickiness in the long end, particularly like 30-year bonds everywhere in the world have gone up in yield this year. And that may also be a reflection of that fiscal situation that I talked about earlier and that concern about inflation down the road. If deficit trajectories continue on the course they're on, there will be problems in the financial market. That event is inevitable. You cannot keep running deficits that get ever and ever larger, especially with the level interest rates are at right now. It makes it very tough for governments to manage their budgets. France is a case in point right now. The US is a case in point. That's something that we're watching and something that needs to be watched. So the backdrop remains, I would say, positive for equity markets, but of course we're watching those things I talked about. So I'm going to let Nick Davis walk you through some of the highlights of this year and where we have done very, very well and where your investors have done well in our portfolios.
Commodities has been an area we've had exposure to both in oil and in mining and gold through solutions and in cautious in particular. We have direct exposure there. One area that has been having us concern and a key area for owning those mining stocks was copper and the growth of copper and the need for that to implement the creation of grid works and the demand for extra electricity. What we're seeing now is that demand coming through in a greater level and greater focus on that as an area of interest and investment. So over the last month we've seen a really strong rise of nearly 30% in Anglo American, one of the positions in the portfolio. One of the other key areas we've talked about over time has been the financials, and again the banks that we have in the portfolio remain relatively strong. We have shifted over the last year from holding lots of banks in America and to rotating away from that as our view changed into Europe. And one of the areas that's done particularly well for us has been Commerzbank, which we sold, but also in Piraeus Bank, a Greek bank we bought, which has seen a tremendous rise over the last year, which has almost risen over 100% since we bought that position in the portfolios. Technology again is a key theme, and it's an area that I think we've mentioned this previously, I've talked about this, that we are concerned about the level of expenditure going towards AI and the actual impact that will have on these companies involved in it. There is definitely an AI race to be the best, to have the best language model, because that will be the dominant force going forward. But what we have looked at is the people supplying the components for that, and that's been the chip makers, Qualcomm, TSMC and Samsung. And Samsung has been a fairly difficult ride for us over this year, but of late the performance has actually massively picked up, and over the last quarter and last month we've seen a strong rally in the share price. This is really driven by the demand for chips, and they have a particular chip that they provide that provides a very cost-effective alternative to those provided by other well-known providers. We also increased our exposure to China, as China, if you remember, came out with DeepSeek, the alternative to ChatGPT, their own AI launch onto the world. And our exposure to China has really been through Tencent and through Alibaba, two large sort of tech-related companies there. Now, defence stocks we've talked about, probably add an item to you about this. And again, they had a very strong rally at the beginning of the year, and they've ebbed off, but again, over the last month and the last quarter, we've seen really strong runs from those holdings. So, in short, the performance we've had since we took over just over a year, you would have seen reflected for your clients, and over the year to date, the returns have been high double-digit returns for Solutions and Dynamic. Dynamic is the full-fat equity growth international portfolio with a literally 100% equity weighting. Solutions is running about a 70-30 equity fixed interest portfolio, and for those people who feel the need to have less risk in their lives, then there's Cautious with the 25 to 30% in equities and the 70% in fixed interest and near cash products. So that's for people who are slightly more nervous about markets or need something that has a little bit more than cash levels of return for near-term requirements they have. So once again, I'd like to thank you for your support over the last year since we took over, and hope that the results that you've seen from the themes we've been following, you've seen that work for you and for your clients, and we look forward to your continued support.